Hi guys. Today we will analyze NXP Semiconductors stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also recent evolutions are not positive. The short-term trend is neutral, while the long-term trend is still negative. We need to see a little more continued positive action to open a long position. Strong support levels are around $170 and $166. Next strong support levels are around $154 and $140. Strong resistance level is around $185. Next strong resistance levels are around $195 and $225. In the last month the stock has been trading between $165 and $186 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 3 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since December 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 4% per year, for last 5 years. We see that the average profit margin of the stock has been around 14% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 284% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for NXP Semiconductors Company: bad, average, and good. First scenario. NXP Semiconductors will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 3%. Future profit margin would be low, 12%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $74. Second scenario. NXP Semiconductors will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 5%. Future profit margin would be average, 14%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $100. Third scenario. NXP Semiconductors will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 7%. Future profit margin would be high, 16%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $132. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 8.05. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For NXP Semiconductors, analysts forecast growth rate around 7% per year in next 5 years, and future P/E around 13. Again, I will use 3 different scenarios for NXP Semiconductors Company: bad, average, and good. First scenario. NXP Semiconductors will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 3%. Future PE would be low, 14. In this case, the fair value of the stock today would be $62. Second scenario. NXP Semiconductors will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future PE would be average, 18. In this case, the fair value of the stock today would be $95. Third scenario. NXP Semiconductors will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 7%. Future PE would be high, 22. In this case, the fair value of the stock today would be $138. As you can see, today the stock is overvalued, $180, even if we expect the company's high performance in future. The company has a good profitability rating, but there are some minor concerns on its financial health. Also, the company is expected to show a small growth in the next 5 years. Based on that, the stock looks overpriced at the moment. I may consider buying the stock for the dividend, when the stock drops below $130. Company's strengths. NXP Semiconductors is a Dutch semiconductor designer and manufacturer. It was spun off from Philips in 2006. It's a leading supplier of chips for the automotive sector. It is also strong in the industrial, Internet of Things market, and near-field communications markets. The company markets its products globally to original equipment manufacturers, original design manufacturers, contract manufacturers and distributors. Catering to the top 20 automakers, NXP's automotive radar business will continue to benefit from the rise of advanced driver assistance systems in vehicles. In 5G, its RF power amplifiers benefiting from the deployment of 5G, catering to major equipment providers. NXP is the clear leader in mobile wallet solutions, which incorporate near-field communication and secure element chipsets, along with the firm's software. As mobile payment adoption expands worldwide, NXP is poised to benefit. NXP should generate healthy margin expansion, as it grows across a variety of end markets. NXP's return on equity of 33% and profit margin of 19% are amongst the best of the industry. NXP's return on assets of 10% is in line with the rest of the industry. The industry average return on assets is 7%. Risks. NXP faces risks related to economic growth, interest rates, fiscal, monetary and trade policies, tax rates, and changes in end market demand. Historically, the semiconductor market has been extremely cyclical. Semiconductor supply is partly driven by the addition of new manufacturing capacity, which has varied significantly over time. With customers building inventory and demand likely to slow later in 2022, there is still a risk of a more significant sector-wide correction in 2023 and 2024. NXP has a growth by acquisition strategy that has resulted in high debt and high levels of goodwill on the balance sheet. The company also faces risks in integrating acquired businesses. The scarcity of experienced analog and mixed-signal engineering talent within the industry. Competitive and geopolitical risks. China is an important growth market for NXP. NXP has limited scope for driving substantially higher revenue or margins in the near term. The company is expected to show a small growth in revenue. In the coming 5 years, the revenue will grow by 5 to 10% yearly. Based on estimates for the next 5 years, the company will show a medium growth in earnings per share. The EPS will grow by 10 to 12% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.